Crypto markets stay range-bound as stocks remain for sale. ETH drifts slightly higher on a relative basis as the merge approaches. Volatility markets start to feel the pressure of lower realized, even in ETH, with huge event risk only a week away. All this and more in this week's Crypto Insight. In Bitcoin, we can see that this support zone of 17.5 to 19K on the chart, that's the key area to hold. Once that breaks, and I suspect it will, I think 10 to 12K is where the ultimate bottom is reached. That's my suspicions on Bitcoin. Now, we may get a positive move on the merge next week. I think we're probably going to cap out around 22K on Bitcoin. If we look at Ethereum, you can see it's down a good 20% from its highs that it made in August. It's down from 2000-ish down to here, around 1650. That could well then retest those highs. And if it breaks them, who knows how far it could go. But it's got some room back. Now, if you look at the relative cross rate, though, it's really on the moon, right? Blue sky target that I put in a while back is now only 5% away on this relative cross rate. So a massive outperformance that we've seen between the two. If we go back to the lows here in June, this thing has done 80%, well, not 80, nearly 80, right? 75% outperformance or something, right? Which is pretty staggering. So, I wouldn't be surprised if we push through that, to be honest, now, given that we're here, but it just may not last very long, right? It may get faded. So you might get a knee-jerk move and then it gets faded pretty fast. That's kind of where I'm leaning towards, okay? If you look at some of the concerns, so QCP, they pointed out, so they do this crypto circular. Obviously, the supply, the issuance of ETH is going to drop, and that's what everyone's excited about. There's another side to that coin, which is the burn rate, right? In terms of determining whether it's inflationary or disinflationary or deflationary. And the burn rate has been in decline for a while, right? All year, the burn rate of ETH, since they implemented EIP 1559, has been on the decline. So compared to when they first implemented it, it's like they're burning like 25% of the tokens that they were burning, okay? If you look at where that's coming from, it's all dominated by NFTs and DeFi still, okay? So the idea being, if you're not suddenly going to see a massive increase in usage from NFTs and DeFi post the merge, DeFi yields are disgusting. Apparently they're lower than like TradFi yields now, right? NFTs, that whole NFT hype has kind of died down. So there's going to need to be a reason why that's going to suddenly go up again. So whilst you don't have a massive amount of fees being burned, then maybe that kind of deflationary aspect doesn't kick in yet. And then the last thing that they point out is that seasonality is horrible, right? So both Bitcoin and ETH typically go down in September, and ETH, it's got like an average of 17%, right? If you average the last 6 years, it's been down 5 out of the last 6 years with an average down 17%. So seasonality looks pretty poor, basically, right? So these are things that may keep a bit of a lid on it. I still think we get a knee-jerk higher just cause on the event because it will happen. But then, yeah, I expect it to be faded, and I think these headwinds will mean that it's probably not going to run away too much to the upside, basically. That's kind of my suspicion there, okay? Gvol, what they allow you to do is they allow you to plug into their API and get the data, and then you can manipulate it yourself. So this is what I'm using here to generate these charts, right? The Gvol API. So if you look at what's been going on, realized vols rolled over, it's about 40% now on Bitcoin, right? It's kind of as low as it's been in the last year or two in terms of realized, right? 1 week to 1 month realized. You're seeing implieds are just kind of sidelining there, not doing a whole lot. So they're still holding because of the event risk that is coming, but realized just absolutely rolling off a cliff. And same sort of thing on Ethereum. Ethereum realized down to about 70 now. So you can see a positive carry in the order of magnitude of 20 to 30 vols across the two assets, basically, right? So really juicy there. It's about as high as it gets, 90th percentile type levels in terms of how much positive carry there is. So it looks pretty inevitable that implieds are going to come down after the next round of catalyst passes, right? So we've got the merge and we've got FOMC. Once all of that's gone and we're looking at the back end of September, I would expect all these vols to have traded down to be more in line with their implied or with their realized, or the realized to have popped back to justify those vols. But right now, those vols are not justified. Okay. If we look at the term structure, we see the steep contango in Bitcoin, as you'd expect. And obviously, we've got this kind of kinked curve, more flat curve in Ethereum. But even that, you're starting to see the September bucket give way, right? So last week, it was much more pronounced, well above 100. And now you've got the whole curve kind of below 100 as the pressure from the low realized is kind of coming and hitting that vol space, right? You look at the relative value term structure, you can see same thing. Set was above 35. It's now gone back to about 30. The whole curve kind of compressing, and we're starting to see there's definitely a gravity there that's starting to kick in, and post the event, that's only going to accelerate, in my opinion. Okay. Looking at the skew's kind of flat across the two, Bitcoin and Ethereum. They're kind of trading in line. 1 month skews at around 11, 12 for puts, so pretty steep. Obviously, protection buying did kick in over the last, as equities have been heavy. People are looking for those macro hedges to the downside. So we definitely did see some protection buying on Bitcoin come in. I'll highlight that when I show you the flows. But then obviously Ethereum skew also hanging in there as people are hedging that sell the fat scenario against any long beta that they might have in Ethereum. Okay. Obviously, we mentioned the spread and we're starting to see it rolling over. So the white line is the 1 month spread. That's kind of peaked out now and really starting to come down. I suspect it's coming down to at least 20 vols, maybe 15 vols in short order after the move, provided the move isn't something ludicrous like 40%. I think we are going to see that. Now, the trade that I've been talking about doing, obviously, is the short vol on Ethereum versus long vol on Bitcoin. So, yeah, in terms of the flows, on Bitcoin, we saw protection buys kick in. So we see here quite a lot of put activity going on there. That was dominating the Bitcoin flows. You had 18,000 puts in 9th of September for this week. You know, they look like kind of dead money. But 30th December, 10,000 puts. That was a big clip. That was this green one here. And also some end of September put spreads going up, right? So quite a lot going on there. There were some kind of in the money call spreads being bought out to December as well as kind of a buy the dip type trade, which were a little bit unusual. The 17K, 28K and the 17K, 30K in the money call spreads being bought as well. And then on Ethereum, there was a strangle buyer in October, probably someone who's thinking like along my lines, wanting to sell the Vega part of the curve and using some out of the money wings as protection, right? If that's not why they're buying that strangle, I have no bloody clue why they're buying that strangle, right? Because that is the only reason I can rationalize buying that strangle, okay? Given the vol levels. And then September protection going on down there as well, but quite a lot of call structures still playing around. December, 35, 4,000 call spread, some December flies, probably people kind of rolling strikes down. Obviously, we know a lot of people bought those 2,500s in December as part of their call structures. They may be rolling some of those down to the 1,800 area. And then a September call spread as well, 35, 5,000. That's way out of the money. It's a bit of a lottery ticket on some crazy re-rating to the upside, which I really don't think we're going to get, but we'll see. I might be proven wrong. Okay, that's the flows. Over to you guys.
On-chain for this week. The general theme for the on-chain this week was basically Glassnode was taking a look at the short-term versus the long-term outlook for Bitcoin, trying to decipher where we're at with this current market. The top charts here, we're going to go ahead and look at the short-term. On the bottom, we'll look at the long-term. Starting here in the top left, we're looking at the accumulation trend score, which basically just looks at the relative size of entities that are accumulating coins. How big are these entities that are absorbing coins right now? And also the amount of coins being acquired or sold within the last month. So basically what you get is you get blues and near 1 when you have mass accumulating in the market or the big participants accumulating. And then you're in the yellow oranges near 0 when you have not necessarily aggregate selling or distributing, but at the very least, no accumulation going on. And so what Glassnode's pointed out is in the past 12 months, we have pretty distinct 4 phases, 4 regimes that we've been in. So coming off the November 2021 high, we had a distinct accumulation phase, deep purples, near almost a perfect 1 score. Basically, there was still a lot of exuberance in the market. People just saw it as a buy the dip opportunity. So they were soaking up as much coins as possible. But as price continued to grind down, eventually went to phase 2 as people came into the realization that the bear market is real and price just continued to climb down. And a lot of those recent accumulators from phase 1 became underwater, and they decided, they couldn't handle the pain anymore, and they started to sell. And you could see that we got more and more yellow until eventually we moved into this phase 3 here, which was triggered by a collapse of Luna. So you had that Luna collapse, and then you had a deleveraging across the entire market. And basically we capitulated through 30K, and then we capitulated through 20K. And most market participants saw this as an opportunity to get long, get some cheap, valuable coins. And that's why you see, again, we went back to almost a solid purple or a blue with a 1 score where everybody was accumulating. But again, time went on, things didn't recover as one would hope. And then we went to phase 4, where as the market moved to 24K recently, all these recent accumulators took the opportunity to find the exit liquidity and got out around that 24K mark. Last week, if you are able to reference back to the on-chain in the notes, you'll see that we looked at the spent output profit ratio to show is the market in profit or in loss. And that pointed out that, as soon as the market went back in profit, we quickly sold off, showing that same thing that we see here in the top left, basically that market participants are grabbing that exit liquidity right now as soon as they can. And that can be seen further here in the top right chart when we look at the entity adjusted unspent realized price distribution. A lot of words, a mouthful, basically just to show you where all the existing coins are and at what price they were last purchased. So, for each bar, those are coins that have been purchased that haven't been moved yet. The red is the short-term holders, the blue is the long-term holders. And the basic takeaway here is that you can see in our recent price range around 20K, right here, a little bit below, a little bit above, you can see a ton of short-term holders came in, to try and get that value, that discounted coins. But as price moved up to 24K and we sold off again recently, going back under 20, you could see that pretty much all these participants are now underwater, and under 20K, there's little to no supply to give us support. So if we do see a bit of a further flush out, if the macro happens, if the Ethereum merge doesn't happen like we might expect it to positively, then we could get a test of these lower numbers under 20K where there isn't a lot of support. So really the onus right now is on the short-term holders to have a little bit more strong hands. If they're investors and not necessarily short-term holders that just need to mature, we should be all right. But if they have weak hands, we could see a flush out, and there is a lot of space down here to work our way down towards 10, 15, 12,000, whatever it may be. Moving on from the short term onto the long term, here in the bottom left, we're looking at the Bitcoin liveliness. We've discussed that once or twice before, but as a quick reminder, the liveliness is just looking at the sum of all the coin days destroyed compared to the sum of all the coin days created. Again, a quick reminder, when a Bitcoin hits an address, it immediately starts counting how many days it's been since that coin is moved. That's coin days created. And the second that coin does move, it takes all those days and adds them up. That's coin days destroyed. And basically what you get here is it's able to show a regime of hodling or spending. When you're trending up in this orange line, or trending up, you're in a spending regime. More people are spending coins than they're holding them. And then when you're trending down, you're in a hodling regime. And so Glassnode is saying right now we are firmly in a hodling regime as we've moved past these peaks of the 2018 bear, and we are just moving further and further down, really just showing that the highly convicted, the hodlers, the long-term holders are the only ones that seem to really be left, as the short-term players are getting in and out very quickly, as you could see here. And so moving on to the bottom right, sticking with the macro, the long-term outlook, we have a chart here that's showing three things at once. That's the long-term holder supply, the accumulation addresses, and the illiquid supply. So the long-term holder supply, a reminder, the long-term holders is anyone who's held for about 5 months, 155 days, which you can see that threshold for that is right here, which means you purchased around April. And then your accumulation addresses are any addresses that have received 2 or more payments but have never spent. And then your illiquid supply are addresses with little or no history of spending at all. And so basically what you can see is as we pass that long-term holder threshold around 155 days in April, all three of these metrics just completely took off, especially the accumulation addresses and the illiquid supply. And then you combine that with the long-term holder supply, it was middling, but then it really has taken off as well, all reaching new highs. It's basically just confirming what the liveliness is showing us, that we are in a dominant hodler regime. There's not a lot of spending going on. The supply is continuing to get locked up. So in the long term, things are looking constructive towards a new bull, but we got to keep in mind the short term isn't looking super great. It's a lot of, it's a little wish-wash, a little mix. So it's not enough to say, okay, we're ready to start a new bull, but it does look like we're trending that way if we can safely make it through these current waters. Moving on from on-chain to the crypto exposed equities, we're basically looking at the spreadsheet here that gives you the different crypto exposed equities compared to Bitcoin's return and also WGMI, that's the Valkyrie mining ETF. And the biggest takeaways here, it's no surprise that most of these had a tough week last week, as most risk assets did, and Bitcoin didn't have a great week either. But the major news came from last Thursday when there was the announcement that Michael Saylor is being sued for tax evasion, and MicroStrategy is being pulled into that for their role in said potential tax evasion. And so you could see here down at the bottom of the chart, MSTR didn't have a great week, but you did have some outperformers here doing better than others. But it's probably worth noting that even though these names like Cypher Mining, Galaxy Digital, Backed Holdings, Mawson Infrastructure, and Hive Blockchain kind of are at the top, and they did seem to perform well this week, with the overall weakness in Bitcoin and the overall weakness in risk assets, it's probably still, it could be expected that these stocks are not quite out of the water yet. And that is this week's on-chain and crypto exposed equities.
Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video, and for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.